if somebody told us we'll have coalition government and we'll have Trump tariffs, West Asia war, India-Pakistan war, feel that we must be 30-40% down by now.
Yeah.
But we didn't get anywhere as bad. अपनी मर्जी से कहाँ अपने सफ़र के हम हैं, रुख हवाओं का जिधर का है उधर के हम हैं.
We've seen since the 1st of June, the Nifty has risen quite considerably. So is the worst behind us?
Well, only dead people can be dead sure. So when you're dead sure, you better step back.
But those are very hot sectors now. How come they don't feature on your list?
If you must buy small cap, then please buy after it has. So the first thing you should keep in mind is that when you do diversification, it's a process of optimizing. It's not a process of maximizing. In the last 20 years, twice the Nobel Prize in economics has been given to somebody who studies psychology. You've given me like a low full toss to make a pitch for mutual funds. So
go for it.
I read out tomes to you about being open-minded. How can I even have such a thought?
A lot of the times investors can't really distinguish whether the fund is just going through a bad patch or now it's game over.
This is a very difficult spot to be in for anybody.
We spend a lot of time talking about making money, but building wealth is a very different game. And to understand that game, it helps to speak to someone who has spent more than 2 decades watching markets, building businesses, managing money, and navigating multiple market cycles. Our guest today is Aashish Sommaiyya, ED and CEO of White Oak Capital Asset Management Limited. His career has taken him through institutions like ICICI Prudential and Motilal Oswal, where he's seen the markets and investing industry evolve firsthand. So today, we're going beyond the usual market predictions. We talk about where we are in the cycle, where the real opportunities lie, what could go wrong, and how much of your portfolio should be global, and what a young investor should be doing with his money right now. So let's get into it. Aashish, thank you so much for being with us today. I think I'll start with the pain point for investors because this is on everyone's mind. The last 2 years have been so frustrating. On an index level, the Nifty has done practically nothing. But yet, despite oil, despite what we've seen on the geopolitical front, FII flows, we've seen since the 1st of June, the Nifty has risen quite considerably. So is the worst behind us?
Yeah, I would say the worst is behind us. And, I'm happy that the worst did not get really absolutely intolerably worse. The reason is that, while you like you rightly said, the index has done nothing in 2 years. But, come on, we all manage diversified funds. And if you look at even a mid-cap fund, it's up double digit in CAGR in last 2 years. If you see flexi-cap funds, they are up high single digits in the last couple of years, CAGR I'm saying. So while the markets didn't do too much, I think thankfully our portfolios relatively did well. And as far as the worst is concerned, I think yes, the worst is behind us because a couple of years back, if somebody told us we'll have coalition government and we'll have Trump tariffs, West Asia war, India-Pakistan war, and then all the macro stuff, right? Capital outflows, oil prices, rupee, all of that. You would have thought, and sometimes you listen to social media discourse or some discussions, you feel that we must be 30-40% down by now.
Yeah.
But we didn't get anywhere as bad. And I think the worst is behind us because of 2 reasons. One is because our corporate performance has held through pretty strongly. I think whatever fiscal policies, monetary policy, whatever the authorities have practiced, plus corporate performance has held through quite strongly. And at the same time, the external headwinds seem to be kind of receding and, giving us less pain.
Fingers crossed.
Sure.
Yeah. Okay, so those are the 2 reasons, the external headwinds as well as the corporate performance. And like you said, with the barrage of bad headlines, one would have imagined we'd have been in far deeper trouble. But I think the fact that we've done nothing much is a far better scenario to be in. Absolutely. But you said that comparatively your portfolio has done better. So now everyone who's watching will say, hey, I want the same outcome. So if someone is saying, I have about 10 lakh rupees, I want to invest today at this point in time, where should I invest?
See, I think, by and large for most investors, and when we are having a conversation, we are not talking specifics, we are talking something relevant to the general audience. If you're looking at equity, I think this is the time to just look at a multi-cap fund. Okay. And, when I'm saying multi-cap fund, I'm pretty much basically saying nothing. The reason being that I don't think this is a time to really stick your neck out in terms of sectors because you can see that even sector performance is kind of rotating. What was working 2 years back, 1 year back versus what has worked in last 3 months, there is a kind of rotation in the market. Even if you see market cap performance, people have been saying small caps won't do well and, go for large cap, blah, blah. but the corporate performance is still with the broader market rather than with the large cap. So I think that after 2 years of practically not much return, if you're starting to invest now, or kind of looking to allocate, I think multi-cap is your best bet, because that is as wide a net you can cast as possible, and that's probably the right thing to do right now.
Okay, so cast your net wide, look at a multi-cap fund. But, we have had a fairly decent corporate season, like you said yourself, as compared to what the rest of the market has delivered or what we would have expected. The corporate earnings have done well, while the market returns have been fairly frustrating, if you could put it. What's the reason that you would attribute that to? Is it simply that valuations had gone far ahead of fundamentals and earnings, and now they're just catching up, the earnings?
No, I think, see, when you look at corporate performance, I think, yes, first is if you look at market performance itself, then clearly, in 2 years, if you have high single digit, low double digit nominal GDP growth, at Nifty level, if you have high single digit, low double digit earnings growth, and small and mid cap, let's say you have teens or plus kind of earnings growth, then in a couple of years, automatically market becomes 20-25% cheaper in any case.
Yeah.
If you look at it from a foreigner's perspective, because of currency, it's another 10-15% cheaper. I spoke in terms of external headwinds, because you can clearly see that there is a question mark on sustainability of this whole data center capex and how South Korea and Taiwan are doing. So that's what I meant, that our corporate performance has held up and external headwinds are receding. And then if you really look at it, I think that the whole manufacturing, ancillary manufacturing, industrials, a lot of those segments have actually held up through this entire. If you look at export and import numbers, if you look at credit offtake, right? So all of those indicators seem to be showing that industrial activity is pretty robust. And I think that is what is explaining the broader performance, really.
So then are those the sectors that you would look to in, take a long-term fundamental view on? Because you were saying from a sectoral standpoint, it's churn. There's a complete churn that we're seeing. So where is it that the opportunity is ripe from a sector standpoint?
Sure. So, ab initio, when we are looking to construct portfolios, like maybe I shared with you, we will look to make a portfolio related. I mean, whichever scheme we are managing, we'll take a hard look at the benchmark, and we'll try to ensure that our portfolio is definitely not hugging the benchmark. But at the same time, we are definitely not benchmark agnostic. We are at least benchmark aware. So our portfolios will keep in mind what benchmark are we competing against and what will help us create alpha. So relative to benchmark, we don't make big sector bets. We are only looking for relative outperformance across sectors. Having said so, on your question, it will always happen that where there is good traction in corporate performance, where there is good traction in earnings and cash flows, those are the sectors where the team will find more ideas, and those will end up becoming the overweights.
So where is that?
Yeah, exactly. Sorry, long answer. So I was saying that basically you will find that to be the entire manufacturing and industrials pack. And when somebody says manufacturing and industrials, you're looking at many subsectors, right? I mean, you're looking for electronics manufacturing, electrical equipments. You're looking at ancillary industries, right? Capex ancillaries. You're looking at auto ancillaries. So all of those, and many of those are in the export segment as well. So typically, if you look at the benchmark, maybe you're 17-18% industrials, we would be as much or more actually if you take diversified funds, maybe 20% in industrials and manufacturing kind of portfolios. The second one where we are probably overweight is also stuff like consumer discretionary and healthcare, right? And and IT, if you really ask me, we were never a big overweight, but I think having exposure which is different from what the benchmark heavyweights are, I think that has also helped. So let's say IT is 7-8% of BSE 500. Through this entire thing, we kept looking for relative outperformers and ended up with more small and mid cap ideas rather than the benchmark heavyweights. And I think that has also really helped. Because, in recent times, I have been telling people that IT looks like a contra bet. Because, it was at complete, people were pretty much indifferent to the whole thing, and, many obituaries were written. So I think not getting very pessimistic has also helped.
Yeah, many obituaries were certainly written when it comes to IT, especially the large cap companies who many called, the sleeping giants at the time when the AI boom was thriving. What about, sectors like you pointed out healthcare? Don't you think valuations are looking a little bit stretched here? Are you again looking at the mid and the micros?
Yeah. No, so if you take any of our healthcare portfolios, let's say a thematic fund, I mean, you will find it's predominantly small cap, micro cap, and mid cap.
Okay.
And of course, there will be one or two usual suspects, the large ones, but otherwise it is almost entirely micro cap, small cap. In fact, we would have 6 to 7 analysts covering some 130 odd companies. So it's a very broad spread. And healthcare itself has become very exciting, very interesting. If you see a few years back when all of us used to talk about it, I mean, it just ended up with, maybe some companies exporting to the US or some big domestic names. But now there are many subsectors in it, right? I mean, you're talking diagnostics, hospitals, medical supply, CRO, CDMO, and what have you. So it has become like a very, very broad theme. It's no longer like just one sector.
Absolutely. It's interesting to know the sectors that you're pretty bullish on, with manufacturing and
since you
industrials.
asked about healthcare, I'm not talking about any stock or sector, but just one interesting statistic which I think most people probably don't know. Healthcare as a sector, if you were to plot BSE healthcare index versus BSE 500 and go back, say, 20 years, you'll find that BSE healthcare has beaten BSE 500, but BSE healthcare versus BSE 500, the beta is hardly some 0.5 or 0.6.
Really?
Yeah. So from an asset allocation perspective, or somebody who's very fussed about volatility and statistics and stuff, somebody who's very fussed about risk adjusted return and those kind of statistics, for them it's like quite a an asset allocator's dream kind of thing, because if something beats the broad index in the long term with probably half the volatility, it's a good thing to have in the portfolio.
Half the beta and yet outperformance in the last 20 years.
Absolutely.
Okay, that's interesting for healthcare. Now, everyone and their mother is saying global diversification, Aashish. And it's interesting because you have also spoken about it, but you have cautioned. You've said you shouldn't look at global investing at a time when India has underperformed 2 years and you've seen the US markets on an absolutely extraordinary run. So timing is also very critical. Let's talk about making global diversification in the portfolio an intelligent way. How do we do that?
So, first of all, look at it this way, that all of these things, like you used a phrase, to say that literally everybody is talking about it now. So first we all should learn that, if you just go by the behavioral thought process, then the fact that everybody is talking about it itself is a red flag. Correct?
It's a red flag.
Yeah, because see, like I've been in the mutual fund industry since, say, 1999. The first time I saw, I used to work at ICICI Mutual Fund and we launched a US blue chip equity fund. And then, I worked for very long at Motilal Oswal, and then we launched NASDAQ and S&P 500. At White Oak, we manage emerging markets funds, right? So the point is that when you say that everybody's talking about it now, and why did I say what I have experienced, is because it's not a new concept at all. It's been around forever. I mean, international funds, they have been aware from the best of my memory since mid 2005 or 2006 or sometime. International mutual funds were available. Okay.
But don't you think accessibility now has increased a lot more, which is why people are talking about it more?
No, in fact, Avan, what happened was that there was a point in time when all these funds were available as domestic feeder funds. And that after 2022, in fact, it has become difficult because domestic feeder funds have hit like a cap and you're now trying to do LRS and stuff, right? So what I'm saying is that international investing, the mutual fund industry started promoting it in the mid-noughties, correct? It's just that from 2000, say till about 2020, maybe till 2021, we did reasonably okay. I mean, there are many ups and downs, but India did quite well. And for the longest time, say 2010 till 2025, take 15 years, US was the best performing stock market globally. In dollar terms, India was second best performing stock market. Okay, so for the longest point in time, people were very happy with the returns which were made in India. Now what happened is that in last 2 years, after India has underperformed and other markets emerging markets have outperformed us by maybe some 40% or something. So after seeing that US is at an all-time high, South Korea, Taiwan, some of the other emerging markets are at all-time high, and we are at historic low valuations. So the lesson should be learned that yes, I should have diversified, and yes, diversification helps. You learn that lesson. That lesson is learned. But that doesn't mean you start doing it now. Okay. That's the limited point. So if it was my money, let's say if I had $100 to invest, I would put 50s because of home bias and because of growth opportunities, because of awareness. I would put 50-60% in India.
Okay.
I would put 20% into US. But I wouldn't start with that part now. And I would put another 20% into emerging markets other than India. Correct? So
Okay.
emerging markets other than India, of course, South Korea and Taiwan have taken the toast, but there is still China and Latin America and Middle East and so much more to invest in.
You know, South Korea has taken the toast, but then the solid weightage that some of these tech stocks have has really
Correct.
bruised the overall index
Absolutely.
at the index level. That's
Absolutely.
also a concern, right?
Yeah, so see, automatically, Avan, that weightage would have started to come down and it will come down. So I think what happened in last 6 to 9 months because of SK Hynix and Samsung and semiconductor and memory and stuff, what happened in last 6 to 9 months is that their weightage got really exaggerated, and with correction the weightage would kind of come down. Correct? So the point is that still, because they hit some 30-40% of the index, but still 60% is something else. Like there are big markets like Latin America,
Okay.
there is non-tech China, China itself, then there is Middle East, right? Of course there are other South Asian markets, and of course then there is South Korea, Taiwan. I would say still there is some value in investing in emerging markets outside of India also. And US also, if I had to start, I would look at non-tech. I mean, I would not start with, say, for example, Mag 7 or NASDAQ, but I would still look at the broad market.
Okay.
So yeah, net, I think say 60% India, 20%. And US markets, US, say S&P 500 is not just US, right? It's a truly global index. So when I say US, we are covering like good part of developed markets.
Yeah.
So yeah, 60% India, 20% US, 20% emerging markets. That's how I would do.
Okay, but I have this perennial argument with, some of my family members, and they say, for example, a typical 30-year-old Indian, he's earning in India, he's spending in India, his mutual funds are in India, his EPF is in India, his home is in India. Why then does he need the global exposure? And more importantly, how is he going to get access to information, daily reports, happenings with what's going on with individual stocks, etc., globally? Why does it make sense for him?
But see, you can equally make the argument that one of the reasons to invest in companies and markets outside India is because theoretically speaking, even if you want exposure to India, there are many companies, like I think Apple is anytime now going to become the biggest retail brand in India, right? I think there are not many retail brands in India which have more than like $10-15 billion revenue, and Apple is kind of right up there. So if you think that you want to invest in Apple, even for the very narrow vision that I want to invest in the biggest brand in India, Apple is not listed here. It's listed in the US.
Okay.
So what happens is that a lot of the big brands which work in India are anyway not listed in India. Correct. Second thing is, there are some things which India just doesn't offer. So say India does badly when commodities do very well, but there'll be some market like Brazil or China or Middle East, for example, which will do well when India is not doing so well. You just gave the example of tech, right?
Yeah.
Right. So we know that a lot of tech exposure like semiconductors and all, you don't get in India. We invest in India because it's a large domestic market, but Latin America, China, these are also large domestic markets. So I think that just like you invest in India through mutual funds or through your investment advisors, same way you can invest through mutual funds in international markets also. And the point is that a lot of international markets, they give you exposure which you otherwise don't get in India. So it's probably complementary to what you're doing.
So say someone has never really owned a foreign asset before, and you've spoken about this 20% exposure to the US, not necessarily tech, and then 20% to emerging markets. Give me a sort of architecture as to what the person should try to achieve in the first 10 to 20% while investing globally.
You mean achieve in terms of returns or?
In terms of portfolio construct, what should they look at? And
Sure.
yes, even returns.
So see, I think one thing to always keep in mind is that when you're investing in multiple geographies or asset classes, first of all, do not think or do not insist that they all will give you great returns in tandem.
Okay.
Correct? I mean, what happens is that, let's say there will be times, like say if you look at 2024, right? Maybe India did very, very well, and South Korea, Taiwan were probably not doing much. Like say after 2022, when China was really threatening Taiwan, there was a point in time in 2022, Taiwan was 40% down, correct? And India was outperforming. So what happens is that at those times, you are very happy you are 100% in India and not in those markets. But 2 years down the line, what happens? India is going nowhere and those markets are having a rip-roaring rally. So the first thing you should keep in mind is that when you do diversification, it's a process of optimizing. It's not a process of maximizing. In fact, if you think you're diversifying and still your results show that you're maximizing your return, then probably you're not diversified enough. You're definitely doing something wrong, correct? So when you do diversification, you should always keep in mind that you're trying to achieve a certain level of return with least possible risk, or you're trying to achieve a certain level of risk with the most optimal return, correct? So I think that when people are doing this diversification, they should never put a condition. They should never get disturbed that, oh my God, why did I put it in that market? It's not doing well. That is because something else is compensating. Those interrelationships people probably don't really focus on and they don't understand.
Okay.
So yeah, I think you should look for smooth return profile, not the highest return profile. And always look, after you're diversified and after you've done all this asset allocation, always look at the composite portfolio return. Don't go hair splitting for every component of the portfolio.
Okay, so look at the composite return in your overall portfolio. And like you said, when you're globally investing, optimize, don't try to maximize.
Yeah.
Okay, now let's talk about that foreign outflow picture, because that's been pretty scary. $29 billion in the first half of 2026 is what they sold. Yes, we did see a reversal about in the month of July, about $2.1 billion. What really changed? Why do you think they came back? Is it because India suddenly became attractive, or is it because they had exhausted that trade of Taiwan and South Korea, which had that massive fall from grace?
See, I think at some level, however much we may say about be greedy when others are fearful and the drill, still I don't think that by and large people are not contrarian. By and large, I think everybody is, if you say be greedy when others are fearful, be fearful when others are greedy, the opposite of that is not in English. The opposite of that is what Jagjit Singh said in that song. Jagjit Singh's song, right? He says that अपनी मर्जी से कहाँ अपने सफ़र के हम हैं रुख हवाओं का जिधर का है उधर के हम हैं. So that's the opposite of the quotation on greed and fear, right? I mean, most people are more prone to this rather than the greed and fear bit.
Yes.
So what happens is that people, whatever they may say about valuations and being contrarian, by and large, I think people do get caught up in the momentum. So if South Korea, Taiwan and other parts of the world are having a rip-roaring rally, and if India is seen to be like not so AI and almost like out of fashion, then however much your valuations and currency may be slipping, they'll just not be able to make themselves to jump in. But for them to notice that we are becoming cheaper, or that our fundamentals have held through, or that our external macro management or the monetary policy management is working fine and our fundamentals have held through, for that to get noticed, first South Korea and Taiwan had to kind of cool off, right? If that is still having a rip-roaring rally, then we will not get enough attention, because ultimately my sense is that a lot of the money which was going out was more the emerging markets basket, where we were getting an adverse allocation, or we were getting a allocation out of India into some other markets. So I think that has kind of paused.
So is it a combination of the factors, the fact that globally things were not as appealing, and that...
Yeah, because in 2024 it was exactly the reverse, right? I mean, our growth started to look bad and we started to look expensive, and exactly at a similar point in time there was this whole AI thing which took the world by storm. And I think it became, by mid-26, it became exactly the reverse, that our fundamentals held through, we kind of time corrected, and at the same time the AI trade started getting at least questioned.
So where does that leave us with FII flows from now on? After that mass exodus, are things going to stabilize, or is it still going to be up and down?
No, I think, see, these things never obviously kind of just turn, right? So you will still see, every 15 days or 1 month, some kind of contra trends playing out, some volatility. But eventually, like we said right at the onset, I think the worst is behind us, right? So it's not like, we will see one way up. I think we'll see our market appreciating, but kind of bubbling up rather than showing us a strong beta movement.
Okay. Let's talk about oil as another component in terms of what your outlook is. It's back around $90 a barrel. I think the talks of US Iran, coming to an agreement have weakened now. And then there's still lots of headlines about the Strait of Hormuz, Trump, Iran. With all these variables in mind, it's been so volatile for crude. Will it continue to remain like that?
So, Avan, what is a few things I can tell you, like what one has seen, not like some deep analysis. If you just take a simple chart of crude, what you will see is that in historically, take example, I think 2008 at the worst, crude was $145.
Yeah.
Entire 2011-12 for most points, $100 also. In 2018 also $90, 2022 $129, and then recently what we saw. So you realize that after every big rally in crude, there is a significant correction, and that is because of huge price elasticity, right? So every time the price goes up, there is demand destruction. Suddenly the supply also gets dialed up, and people start talking alternate fuel, right? So what I feel is that despite, and even now if you see in the last few months, despite all these fears, once the price came down, it has never really flared up beyond the point. So I think that the world has seen enough of this volatility. So my sense is that you will see some up and down, but I don't think you will see a big flare up. And I think the market has factored it. That's my sense.
Okay, so no major flare-up when it comes to crude oil prices. You spoke about sectors that you're pretty bullish on. I noticed financials didn't make a mention. Are there certain sectors that you would steer away from, and why no financials?
No. In fact, so see, by virtue of being a relative manager, relative to benchmark, whatever I explained, obviously BFSI is a big sector. But what I find in our portfolios is that it's very broad, like typically when people talk financials or when a lot of discussion happens, it's about bank nifty and the big banks. What I find in our portfolios is that maybe the banks are 15-17% or maybe less than 20%, but a significantly high proportion is actually insurance and asset management and wealth management and brokerages.
But those are very hot sectors now. How come they don't feature on your list?
No, so they are. That's what I was saying.
Okay.
So we are nearly 29-30% in BFSI.
Okay.
But what I was trying to say is that within BFSI itself, we don't have like a very high preponderance with just the banks.
The banks, okay.
In fact, we have a more wider spread in the non-lending financials. And even to some extent NBFCs, but it's largely the non-lending financials, capital market plays and stuff.
Okay, got it. I feel like you didn't mention it, so that's why I felt that I had to ask. Now, White Oak's philosophy is pretty much that alpha comes primarily from stock selection versus sector rotation. So when your analysts are doing this sort of bottom-up work today, which parts of the market is it that they are finding businesses where earnings expectations, the overall quality and valuations are actually lining up?
Yeah, so that's what actually, if you see, by and large, the impression is that small cap is very expensive. But while small cap has done good performance, the ideas are also coming in the micro cap, small cap space, and that is really, if you see, electricals, electrical equipments, electronics, the industrials, manufacturing, all of those are the ones where there are the best ideas kind of coming through. So yeah, that is something that we look at. Plus, of course, we have like some 35 analysts covering 1,100 companies. So there is a very, very, like I said, we cast the net really wide. Yeah. In fact, even healthcare, say chemicals, a lot of those sectors we have significant exposure actually.
Okay, and you believe that it is time for these. Your view is that the mid and the small caps is where the juice lies.
Absolutely. See, for alpha generation, even for a moment, if I say that okay, let's not bet on one market cap doing better than the other, but what one can say with a lot more confidence is that the alpha generation will come from those spaces.
Mid and the small caps.
Absolutely.
Okay. Fair enough. I want to also get in a little bit deeper to Indian IT, because it seems that in the year 2026, everyone had pretty much written off this sector. It was one of the worst performing sectors as well. And then we did see this sort of comeback from the month of July, a sort of rally in double digits of about 16.7%. What do you think is the reason for this? Fundamentally, what has changed for IT? Because the fact of the matter remains that large cap IT did miss the bus when it came to AI. Yes, maybe with an enterprise, there is that opportunity. But what has changed fundamentally for IT?
See, I think it is related to one point which we already discussed, which is that, and now it might be sounding cliche to say, but I've said it before also, over 6 to 9 months, it was a contra trade, and it was a AI contra kind of, anti-AI. So you can, it's not a coincidence that just when South Korea and Taiwan started to, predominantly Taiwan and South Korea, when they just started to fizzle out, is when exactly the outperformance for us started to kick in, right? So it's not a mere coincidence. There is obviously some thought process going on out there. That was clearly one.
Okay.
So when you mentioned the large IT companies, I think what we should not forget is that even within IT, Avan, in every few years, the winners have changed, right? I mean, see, 25 years back, when we spoke of the IT sector, after Y2K and when ERP and all of that part came in, obviously we know the winners were the big ones like Infosys, TCS, all of those, right? But when it moved to SMAC, right, social, mobile, analytical and cloud, then new bunch of winners actually came up, correct? And even now, if you see, when you said that IT started to perform well, the outperformers are actually some of the mid-sized name rather than and even if you see fundamental performance, some of the mid-sized ones, order wins, etc., if you see, some of the mid-sized ones are probably doing better than the bigger ones. So 2-3 things to keep in mind. One is the IT sector outperformance coincided with this whole South Korea Taiwan thing. Second, I think this misunderstanding that ITES companies don't have much of a role to play, and I think that is getting clarified. But the more important thing is, while they have a role to play, we should know that the winners, every few years the winners also change.
Okay.
Right? So we should be open to that. We should be open to identifying who are the beneficiaries.
Speaking of the winners changing every time, it's quite interesting that just last year, when AI and India was not considered the obvious AI beneficiary, that is the time when you actually said that could help India when some of the expensive looking AI markets corrected. And that's almost the time that we started seeing this sort of rotation play out. Yeah. Can you explain that?
Yeah, that was deliberate, because if you ask me, I always thought that, and even before this question came up, I told you that, our performance or relative performance would not get noticed till there is a big AI boom that is playing out, because rightly or wrongly we were always perceived to be not AI or anti-AI kind of thing, correct? So which means that the moment that fizzled out is when people would start to look elsewhere, and the elsewhere will always be the one which did not fall 40-50%. Correct? That is the thing. And as far as the IT companies themselves are concerned, if people feel that, okay, all this capex has come too early, AI adaptation will take time, AI adaptation at enterprise level will maybe take some more doing. The big AI companies themselves are saying that they will want to set up IT companies in order to help, implementation. I think all of those things kind of came together for people to realize that, okay, these guys are trading at historic low valuations. Look at the cash flow yields and stuff. And maybe they have a role to play. Things are not as bad as, we've made it out to be.
So Goldman Sachs has actually estimated that the AI-related investments could cross $1 trillion by in 2026 alone. So where is it that you are currently seeing opportunity for AI? Who's doing the best job when it comes to AI?
In India, if you really see, we don't have a direct play, but you can see that there is, apart from obviously, like I said, that we'll have to look for mid-sized companies.
Mid-cap IT.
Yeah, mid-cap IT and some new players who will play a role in AI enablement, AI transformation, and take a lead in enterprise development, right? So apart from that, I think you can see that data center investment is kind of being spoken about. And you can actually see that, people who are perceived to be beneficiaries from data center capex, even in India, right? People who are supplying electrical equipment, people who are supplying wires, cables, those actually in the recent times have actually they've done well, right? You can see that they have kind of seen traction in their prices and the corporate developments. So those are the only two direct things that one can see as far as our market is concerned. One, we all know that any capex that we do is always cyclical in nature.
Okay.
And the basic nature of capex is that you'll always have leads and lags in terms of how much capex you made and how much time it takes for that to get absorbed and for real returns to come through. So I would say that this whole thing about higher and higher capex being announced is fraught with risk. It will always, at some point in time down the future, it will always result in overcapacity.
Okay.
And the speed of adaptation, at what rate the the capex is being done versus the actual speed of adaptation, there'll always be leads and lags, and that will actually result in some boom bust kind of thing happening.
Okay.
And like we've spoken 2-3 times, the external market kind of correcting is not necessarily bad for us. It's actually good for relative performance for us.
Okay. And now let's get into gold.
Hmm.
I'm a 25 to 30-year-old investor. Should gold be a part of my portfolio? A, how?
Yeah.
And B, how much?
So, briefly, when we, like, say, for example, when I was a young investor, briefly, there was this point, definitely where gold did not reward and did not seem like a investment at all. Okay. But say somewhere around 2022, when this, Russia-Ukraine war broke out, and the US confiscated $350 billion of Russia's reserves, I think that is where it set the cat amongst the pigeons kind of thing, right?
Yeah.
And early 2023, I was myself involved in creating a fund which had like heavy exposure to gold, because that is where I think the thought process really changed, right? So I think now it is here to stay. I mean, yeah, when I was young, gold was not considered to be a good investment. But I think for people who are young today, I think that thought process has to change, because the way the world works and the way the world sees currencies, and I think that itself has changed. So the basis has changed, which means that we would want more diversification, right? So I think, and there's another logic to it, which is that there are some people who are happy to say equity is a growth asset because it has earnings and cash flows. I want to be in equity. And if equity goes up and down, doesn't give returns, someone like me, I don't lose sleep over it. But even beyond the point on currencies and assets, the point is that there are many people who want to invest in equity, but they can't take a big downside. So then, to reduce, if you have 50% equity in your portfolio, to reduce the volatility of that, you do need some 15-20% gold. So given that we are expecting volatility to remain, and given that, how the world thinks about currencies and how much faith people have in how US is conducting its affairs, definitely it's here to stay. I mean, gold as an investment is here to stay.
So how much percentage of a typical portfolio would you say for someone who has decent exposure
so
to
let's build on
equities?
the one which I said. Let's say if somebody has 50% equity,
Yes.
and let's say, I think a good balanced portfolio would be 50% equity, 15 to 20% gold, and maybe 20-30% fixed income, right? That would be, previously what we would say, 50% gold, 50% debt. Sorry, 50% equity, 50% debt. Those kind of things we would say, right? So I would say now you should be more like 50% equity, 20% gold, 30% debt, something like that.
Okay.
And if somebody is very conservative, then maybe 30% equity, maybe 15% gold, and the rest in fixed income.
Okay, so it depends on the category of the investor, but broadly you want equities to dominate.
Yeah, so like when we create, say we create a portfolio which is meant to beat fixed income and give high single digit, low double digit return, right? So how do we construct it? I mean, we are say 25-30% equity. We are into say REITs and InvITs maybe 12 to 15%. We are into gold say maybe 15% or so, and the rest fixed income. Okay. So if it's a conservative portfolio, this is what one would do.
Ashish, since we have you with us, I think let's get all the advice that we possibly can. Assuming there is a young investor, he's 25, 30 years old, he's made his first salary, 25 to 30K a month, never invested in equities before. Design his portfolio. Where does he start? How much does he invest? Where does he invest? He or she?
Yeah, so I think that assuming they do everything right, then the expense will be less than the income, and there'll be something left to invest. And then I would not complicate it. Like I said, I would just every month whatever I save, just do an SIP in a multi-cap fund. I mean, don't complicate it too much.
How much?
$25,000. I mean, if you end up say spending 20,000, so 5,000 at least, somebody should save at least 20%, right? And as the compensation goes up, then the proportion of saving should go up.
Okay, so as the compensation goes up, assuming that there's a larger chunk coming in, let's diversify. After multi-cap, what's my next step? My regular SIP of 5K a month in multi-caps. Now I'm getting a lot more. What should I look at in terms of other instruments, sectors, etc.?
No, so I think, see, by and large, for most people, why I say this is because, sometimes, say you have 5,000, 10,000 to invest, right? And then if you put a lot of money into, say, small cap, and then, I've seen every second year small cap index falls 25, 30%. And then when things are very volatile, it's my learning that we tell everybody you should be a long-term investor, correct?
Yes.
But my learning is that people will not be able to be a long-term investor if the asset class that they pick is very volatile.
Okay.
Right?
That's such a good point.
I mean, high volatility is what, and I've seen that, see, long-term investor is an outcome. And like people say, long-term is a series of short terms. So people will become eventually a long-term investor if over every short term, they have a good investing experience.
But then going by that metric, if you say pick a safe HDFC Bank kind of a stock, I'm just taking it as an example, okay, and pick it for the long term. That stock also in the long haul has done okay. It's not fallen massively. You've not lost a lot of money, but it's done precious little. So is that inculcating then the habit in me to be a long-term investor? Will the investor be dissuaded saying, hey, nothing much has happened?
So you need to see, I think, yes, you're right that it's like a heavyweight blue chip, which is kind of hit a rough patch in the recent times. But that happens when you are holding a single stock.
Yeah.
Right? I mean, it's a good, you've given me like a low full toss to make a pitch for mutual funds. So
go for it.
So yeah, I mean, that is what happens when you own a single stock, because however strongly we may be convinced about it, it will always go through its own patches. But I don't think you run that risk with a diversified fund. See, right at the onset of this conversation when we were saying that in last 2 years, the index is hardly done anything. In fact, it's maybe 5-7% below the all-time high. But our mutual funds are, double-digit returns. So I think with mutual funds, that risk is lesser.
Okay. Now you've made your case very well for the mutual funds. So say I'm a young investor and I want to invest in the long term. What are the top 3 factors that I need to keep in mind while even choosing fund A over fund B?
Yeah. So I would say that, look, there was this point we made about optimizing. I think that, all investment and, life in general is about optimizing. When you try to maximize something, you always end up willy-nilly minimizing something, correct? So I would say that don't look for funds with the highest return because, winners rotate.
Okay.
The ones which aim for the highest return, somewhere down the line you find them giving like a low return, because this, consistency is a lot more important than getting the highest performance.
Okay.
So I think always look for funds which you find that, okay, if they're doing well, they're top quartile, but in the bad patch, in the worst case, they'll end up in the middle. Because, I think giving sustainably above average performance will land you in the top. Whereas if you are at the top, it's highly likely you go back to the bottom.
So consistency.
So first is look for consistency, and mathematically there is a ratio called information ratio, which the regulator has made it mandatory to disclose, right? So that's alpha divided by standard deviation of alpha. I think that is something which people should look for. The second thing also incidentally we discussed, which is that when you are just starting your investment, you don't want to get waylaid into something, so I'll give you a simple rule of thumb. The narrower the segment, look at BSE 500. It's very important for anybody to get a good understanding of what is our market. And the market is kind of pretty much covered if you look at BSE 500, okay? So my rule of thumb is that when you look at BSE 500, the narrower the segment, the more the volatility and the cyclicality. So if I'm a young investor starting now, I should make sure that I start with something which is front and center in the market and not a narrow, not a narrow sliver or corner or crevice
so
of the market.
weightage wise, you mean?
Weightage wise, yeah. So what happens is, if I'm a first time investor, I start investing with transportation and logistics fund.
Okay.
So what will happen is, when I look at some website or some app, this kind of fund will appear on the top once in maybe ages.
Okay.
Correct? And God forbid if it has hit the peak and it starts to correct, okay, then the market can do whatever it wants. If it doesn't come back in vogue, it doesn't come back in vogue. Correct? So never start your journey with something which is a very narrow sliver of the market. That's why I said start with multi-cap, because multi-cap covers, it's unfettered, right? It covers every market cap, every sector. So the chance that even if you take the worst multi-cap fund, the chance that you will be waylaid in the market is very less.
Okay.
Correct? But if you, with the best of research, you pick the best transportation and logistics fund, If it doesn't do well, I think nobody will do well. You will be stuck for 5 years. And
Okay.
that, by the way, I'm not negative on any one sector. That's just an example to tell you a
Understood.
narrow part of the market.
Yes.
So even small cap, we may be fascinated with it. We also do a lot of work in small cap. But look at a pure small cap fund. Small cap totally is 20% of the market. Every second, third year, it falls 30%.
Yeah.
And then it takes a couple of years to recover. Does it ever happen with BSE 500 itself? Does it ever happen with a multi-cap fund? Does it ever happen with a flexi cap or large cap fund? Answer is no. Correct? So I think you need to be
Decent weightage.
decent. You should be in a segment of the especially when you're starting out new, you should be in a segment of the market which is a meaty segment of the market,
Okay.
and not some corner of the market.
Okay. So consistency, meaty sector, anything else? Or meaty weightage rather.
Weightage. And the third is that don't invest in a way, don't do anything which will throw you out. See, it's like, when you talk about a cricket, take an example of cricket. Okay. There are many times, Avan, you find that it's a very tough match, very bad pitch. Okay. And the commentary or the experts will always say that if they don't lose their wicket, they'll win. Correct?
Yeah.
In a T20 match, you can't say if you don't lose your wicket, you will win. But the good news is that stock market investing is not a T20 match.
Yeah.
Correct? So in this, you stay on the pitch longer, don't lose your wicket, you will make very good returns. But if you try to do something very aggressive, like you're trying to hit a six on every ball, you lose your wicket, you're out, you're not coming back.
Okay.
Correct? But if you are very conscious that you take one run on every ball that you face, and once in a while you get a loose delivery, you hit it for a six. That is the
Yeah. So basically, don't try to hit a six in every ball. Don't be too aggressive, is what you're
yes,
saying with your
focus
moves.
on staying in the game.
Staying in the game, right? So let's just walk us through, the extensive research that goes down with a white oak investment decision. What is the key criteria? Because you said that there's so many companies that you shortlist. What is the key criteria that you say that now this looks interesting versus this one's going to make the portfolio?
So, first is that we are, like I said, first is that we are very disciplined about, maybe I'm repeating a couple of times, but we are very disciplined about what index we are competing against. Okay. So nothing is in vacuum, nothing is in isolation, correct? And we cover practically every sector in the market. So fund managers at our end, like our CIO or our fund manager, their prime job is portfolio construction and risk management. Whereas what goes into the portfolio is largely dictated by the analysts. And I'm clarifying that because in a lot of fund houses, it's the fund manager who's the be all and end all, right? An analyst maybe just pitch stocks. At our end, fund managers focus on portfolio construction, risk management, whereas the analysts are the ones who are the dominant force in the inclusions, correct? So that brings you down to sectors, which means that we have all these sectors. Depending on the attractiveness, depending on the ideation, we may be overweight in some, we may be underweight in some, but by and large, everything that is there in BSE 500, we will have exposure to those sectors, correct? Within the sectors, right? Within the sectors, what we are looking at is 3 or 4 things. One is that, needless to say, governance and management quality. I mean, that goes without saying, because governance and management quality will determine the execution, right? The second thing that we will look for is we are looking for basically companies. I mean, we have a hypothesis about, so we do discounted cash flow, and we have a hypothesis about the earnings potential of each of the companies that we own. So based on our hypothesis, any company that we own, the return on invested capital in cash flow terms should be more than the cost of capital, right? And when I'm saying cash flow terms, basically look at it this way, that companies trade on PE multiple multiplied by the EPS, right? And this EPS is composed of the PAT, right, which is more like an accounting number, correct? So we are not looking at stuff like PE multiples, we are not looking at just the PAT number, we are looking at actual cash flow projections. And from those actual free cash flow projections, the first thing we will do is we'll deduct the cost of capital. So in some ways, what you're looking at the, kind of a cash flow return on investment, or like people look at PE multiple. We look at price to capital light free cash flow. When I said we deduct the cost of capital from the free cash flow, that basically means we're looking at the capital light value of the company. So we have our own valuation models. I mean, we have an OpCo-FinCo framework where we divide a company into operating company and financing company, and that's how we arrive at what I mentioned to you. And obviously, the other thing which I kind of missed out is basically we are looking for companies which, companies and sectors which have a kind of, scalable future. See, because ad nauseum people speak about discounting the future, right? Which means that companies should not be in sectors which have, kind of sunset around the corner, and, which are operating in sectors which have like a scalable future. So broadly speaking, these three things, I think management quality, execution, and governance. Second is what I mentioned about valuations, but on a capital light free cash flow basis. And third is obviously the scalable businesses.
Okay, so that's quite the criteria, but you touched upon PE, so I'm going to talk about it because you've previously said that the fact that PE is an indicator of value is a myth for investing. Why?
See, the reason is, one is what I mentioned to you itself, which is that look at it this way, that when you look at price to earnings, correct, it does not do enough justice to the quality of earnings, right? Like for example, when I told you that we look at instead of price to EPS, we look at price to capital light free cash flow, right? So basically what I was trying to say, the way I mentioned it, you will realize that it kind of removes the distinction between the capital structure of the company or the capital intensity of the company, the way we actually compute it, correct? When you look at PE multiples, irrespective of quality of the company or quality of the earnings, it kind of brings everybody on the same playground, which is not really fair. The second important thing is that beyond just the distinction that we make, look at it this way. When you look at PE multiples, people ad nauseum say let's move from companies, look at countries. People ad nauseum compare India's PE multiple with China's PE multiple. Yeah. I mean, that's the most common thing. Now look at it this way, that PE multiples are also an indicator of longevity, right? Let's say 20 is the PE, 1 rupee is the EPS, so that makes 20 PE. One way to look at it is, if the EPS 1 rupee remains 1 rupee, you have bought 20 years of earnings. So the higher the multiple, somewhere the market is telling you that the longevity, visibility, and scalability of the business with higher PE multiple is much more. And like say $1 earned in India is equal to $1 earned in China. But $1 of India, people are willing to pay 20, and $1 of China, let's say people are willing to pay 10. So somewhere they are telling you that the sustainability and longevity associated with this $1 is not as much as the sustainability and longevity associated with the $1 earned in India.
Yeah.
And there is enough research internationally to show that countries which have, the 4 pillars, what you say, right? Like you have free press, you have judiciary, you have the executive, and then you have the parliament or the polity, right? So countries which have a functioning democracy, they always trade for higher PE multiples than countries with other forms of governance. I mean, there is enough research to show this. So apart from the company specific characteristics I told you, even the PE ratio just mathematically is not amenable to comparisons. Okay. It misses a lot of nuance.
Okay, so that's quite clear that it's not your indicator of value. Now, when everyone talks about the stock market, buying gets all the attention. Buy when this, buy when X, don't buy when X. But what about selling? When do you actually sell? When do you know that it's the right time to exit a company?
See, from our perspective, because we look at relative return, at White Oak, I think since we are very focused on beating the benchmark, if we find that there's a lot of return made in a relatively short period of time, right? Then, we are happy to trim that. I mean, we may not make a complete exit, but we are at least happy to trim that exposure and put that money to work all over again. That is because of a relative return framework. So one answer clearly is that we reduce exposure or sell a stock when it's run up too fast, too soon, and, valuations wise, we want to. See, you look at simple math, right? I mean, in long periods, the index compounds 12%. We are here to beat the index. In 6 months, if a stock has doubled, then probably it's done a lot for us as far as that particular year or as far as that target of beating the index is concerned. So because of relative return focus, we might see slightly higher turnover in such cases, and we will, redeploy. We may not make a complete exit, but we will redeploy. Second, obviously, I think, apart from all these relative performance considerations, clearly, when the hypothesis is not playing out,
Yeah.
Because like I said, we have a hypothesis on every stock. We have our own models on every stock. When it is not doing what we thought it would do, that's clearly a cause for, exit.
Does the same hold true when it comes to an underperforming fund? Because I think a lot of the times investors can't really distinguish whether the fund is just going through a bad patch or now it's game over. So what's the criteria?
This is very difficult. This is a very difficult spot to be in for anybody. Whether it's a manager who's having a temporary bout of underperformance, or an investment advisor, or a investor. And that's why, actually, if you ask me, that's my learning after so many years. And that's why we are so focused on relative return. Because, what happens is that it's a very tricky thing. Like when you said a fund is underperforming, then it behooves everybody concerned, especially the investor and the advisor, it behooves them to then, open the hood and go a level deeper and see that why is it underperforming? And what will cause this underperformance to get corrected, correct? So what happens is that a lot of managers, and most managers, they have their biases, they have their beliefs, correct? And you must have seen that some people are growth oriented or value oriented, or they are small cap specialist or a momentum, or, some people focus heavily on very, just 5 stocks. So everybody has their own beliefs, correct? And BSE 500 unfortunately has no beliefs, right? The index, the biggest index is not growth or value. It's not large or small cap. It's not PSU or private. It's not defensive or cyclical. So when macros change, which part of the market will work or not work, that will keep changing. And as a result, everybody's beliefs or recipes, sometimes they're tailwinded, sometimes they're headwinded. So if somebody is underperforming just because currently what they believe in is out of fashion, okay, then you have no choice but to stick it out.
Okay.
Because see, in 2021, if you entered a fund which believed in quality, then now I think it's almost 5 years that you are witnessing underperformance. And only in the last 3-4 months, it has started to kind of turn a little bit, correct? So if you enter a quality fund in 2021 and by 2025 you say that this fund manager is doing something wrong, well, he's doing what he was always doing.
Yeah.
It's just that we caught the cycle wrong, correct? So if something is underperforming because it is doing what it is supposed to do and the market is not favorable, then you could even double down.
Yeah.
The least you could do is wait it out, okay?
So
or you could say that I should not have done this and move to a guy who's a more balanced guy and has no style, right? So I think very difficult, but you really need, instead of just pressing the button, you need to go one level deeper and find out what is causing the underperformance.
Okay. So relative returns, scrutinizing that is very important, right? In order to determine
And the cause, and the cause of why the return is not stacking up.
Okay. Now a young investor sees mid caps outperform and so buys mid caps, small caps outperform, buys small caps. So should the market cap categories ever be chosen based on what is working currently? Should large, flexi, small cap, for example, have a permanent job in the portfolio?
Yeah, so see, because you are saying young, and I'm associating young with beginner and maybe relatively less experienced,
Yes.
right? Relatively less conscious of nuances. That is why, like a broken record, I keep saying do multi-cap. But still, if you must buy small cap, then please buy after it has done horribly.
Okay.
Yeah, so buy it after it's 30% down. Don't buy it when it is all-time high.
Okay. Any rule, any other rules, any other thumb rules?
Yeah, I mean, no, there's only this, which is that definitely don't buy don't buy after it is setting records.
Okay.
And definitely don't buy when everybody says, see, this is the way to, buy it when everybody says that, arey yaar, see, मैंने देखा है, if I may use a bit of Hindi, in the markets, people have only 2 moods. One mood is that, Apunish Bhagwan hai, that type of thing, right? And the other mood is sab mile hue hain. So when you're in that zone ke sab mile hue hain, that is when you need to overcome your disappointment and start to buy.
But so much about it is not just IQ, it's EQ, right?
Totally.
So tell me what behavioral aspects are big no-nos or big mistakes, and what are the important behavioral or emotional aspects you should adopt?
So, I don't get tired of pointing out to people, and anybody who has heard me must have heard it a zillion times. I always remind people that in the last 20 years, twice the Nobel Prize in economics has been given to somebody who studies psychology. There must be a reason to it, right? Because you studied economics in school and college.
Yeah.
The economics that you and me were taught, it assumes that human beings are rational and logical. Then to give that Nobel Prize to a guy who studies psychology is almost a antithesis, right?
Yeah.
Because psychologists don't believe human beings are rational and logical, right? So I think there is clearly is the biggest admission that behavior is at play. Correct? When you give Nobel Prize in economics to people who study human behavior, means that psychology and behavior is at play, and human beings, after all, are not emotional and logical. In fact, the vice chairman of Ogilvy, Rory Sutherland, he said that human beings are not rational and logical; they are emotional and psychological.
Yes.
Right? So, I think that what is very important is there's another thing which I heard in a Hindi movie where somebody said अपनी सोच के बारे में सोचो. So on your question, when you feel totally convinced that this is it, this is where I must invest and this is what will change my fortunes, उस वक्त सोच के बारे में सोचो. When you are dead sure, because I always tell people only dead people can be dead sure. So when you're dead sure, you better step back.
Okay. So take a step back and review.
Yeah. And the counterpoint is that when you feel ना कि यार ये stock market and all ये casino है यार कुछ नहीं हो सकता है, then you need to bring yourself to that, why am I feeling so, this is supposed to be economics and maths. Why am I feeling so emotional about it?
Okay.
Then you need to overcome. See, it's very tricky because when you're low on confidence is when you need to be able to invest, and when you're very high on confidence is when you need to be able to step back. I think that's the challenge.
But what a lot of investors did was they invested, say, during the COVID time, a lot of new investors who were very young, and they faced a very extraordinary period of an up move, that boom, and then reality sort of hit after a long period of time. What should an investor today expect as a pragmatic return?
I think low double digit annualized, 10-12% annualized on the benchmark and couple of percentage more on a well managed fund. I think that is something that people should look for. Okay. And see, everybody says that people started investing in COVID, but Avan, you must have noticed, and you were around, so you must have noticed that when demonetization happened is when really, digitization picked up, right? So look at it this way. The people who opened so many accounts after demonetization and came in 2017-18, for them it must have been a horrendous journey. And the people who came in 2020, they must have thought, yaar, what is a song and dance? Ye to bahut aasan hai.
Yeah.
Correct? But to everybody who came in 2018, we should say it's not as difficult as it looks. And to everybody who came in 2020, they should know it's not as easy as it looks.
Perspective also. Yeah.
It is meant to be cyclical. I mean, if you feel it's very easy, then it's not. And if you feel it's very difficult, it's not.
Yeah. So take a closer look and review it. Now, you've spent nearly 3 decades in this industry across AMCs. You've watched the dot-com cycle, COVID, GFC, taper tantrums. Tell us your 3 biggest learnings in the stock market. It could be behavioral in nature. It could be just some thumb rules that you adopt. 3 of them.
See, I think first, some of them are behavioral in nature. Because I think ultimately that is what helps you to, digest everything.
So what are they?
The first, if you really ask me, is related to what we spoke, which is that you should be open-minded and you should be probabilistic. See, Avan, who can do asset allocation? People who say that I will do 100% equity, trees will grow to the sky. The market goes down 20%, they are all shaken up.
Yeah.
Correct? So the point is that you should be probabilistic in your thinking.
Okay.
That, by and large, I think this will happen, but there is also a possibility that this other thing might happen. Only people who are probabilistic can do asset allocation.
Okay.
And I think having some semblance of an asset allocation And asset allocation is not about preaching. It's just that it keeps volatility low. It keeps you in the game. If COVID comes and you have borrowed and you are 100% equity, maybe more than, let's say when COVID comes, you're leveraged and you're fully into small cap, you will get thrown out of the game. You're never going to come back. Correct? So asset allocation helps you stay in the game. Keeping volatility low helps you stay in the game. And all those things can happen only if you are somebody who has thought about all possibilities,
Scenarios, yeah.
That's why I said only dead people can be dead, sure, or they will die anyway. Yeah. So I think that's the whole point. That is my learning. The second, so open-minded and probabilistic. The second thing I think is that, never, because my work is a lot about meeting people and about relationships, I try my best never to assume that the other guy doesn't know what he's doing. Okay? Because, see what happens is, the market is the sum total of the opinions and behaviors of millions of people. Correct? We are overly focused on having our own views on the market. But a lot of times we completely forget to even pay attention to what the market is telling us.
Okay.
Correct? So while I may have a view on the market, I should be humble enough. See, like now in 2 years, I'll give you an example. Since 2 years, people are saying India is horrible macro. It is finished. It's a basket case. So, let's say you or me might also feel that way. Yeah, man, rupee is making new lows every day. We are losing like $30-40 billion by the truckloads. We don't have AI companies. Correct? So you also might get caught up in that negativity. And then you see the market slowly and steadily bubbling up. You see earnings playing out. You see companies announcing good order wins and, credit growth rising. So what will happen? You should have the humility to listen to what the market is also saying.
Yes.
It's not a one-way thing. Yeah. So being humble, I think that is the point I'm trying to...
Understood. And also, like you said, just take a step back and review your assessment and try to understand what the market's telling you. Yeah.
And the last thing which I'll say is that, which is also related to, like if you see India as a country, because you mentioned that, like, I have been lucky enough to see, right from the internet bubble. Before that, when I was studying, we were just getting out of a scam. So many things I've been lucky to experience. I can say one thing for sure. The maturity of investors and the reaction of the market is getting better and better. Okay, at the onset of the conversation we mentioned that 2 years back, if I told you of all of this, you would have thought we will be 40% down. And we have been there before. But see the reaction of the market. So what I find is that today, let's say there are 6 crore plus unique mutual fund investors. In 2012, there was 80 lakhs. In 2018, it was a couple of crores. So what is happening is that now you have millions of people who have seen 2 to 3 market cycles. And that is what probably is also driving, of course, regulation, technology, everything. But I think the maturity and how investors are conducting is also driving market behavior.
Okay. So for someone who is watching this conversation, you've given so much advice, we've discussed so many things, but what is the one thing that you want a young investor who's optimistic about investing and starting his investment journey to remember from what you said? If he could just have one takeaway.
No, I always say equities are for optimists. It's just that you should never lose your wicket. I mean, don't bet the house.
Okay. That's equally important. So let's get into a quick rapid fire, Aashish, before we wrap it up. One boring piece of advice that people absolutely underestimate, but it's so critical.
I think being open-minded. See, kya hota hai, when you're 25 years old, I mean, when I was 25 years old, I knew I know everything. When I'm 50 and I know I don't know much.
Okay.
I think that is the difference.
Do you have any investor or a fund manager, someone in the markets, Indian, globally, that's influenced you?
Many people, right? I mean, I've been very, very, very lucky in terms of bosses. I worked with Naren, I worked with Nilesh Shah, I worked with Motilal Oswal, I worked with Ramdev Agarwal, I'm working with Prashant Khemka. So heavily
Tell me
influenced.
one person whose style you think comes closest to yours.
See, if you ask me, I think managing money in a mutual fund is a very different thing. You need consistency of performance.
Okay.
But if you ask me personally, by way of my thinking, I am a bit of a contrarian.
Okay. One financial product that you believe is so overrated?
None of them are overrated,
Nothing?
I'm very
Okay.
sure. Yeah.
A sector that you would not touch with a barge pole?
None.
None. Okay.
I read out tomes to you about being open-minded. How can
Okay.
I even have such a thought
Yeah,
process?
true. Any book on investing that you'd advise someone to read that really changed your life?
Yeah, there's a book which I had read. It's called Investing: The Last Liberal Art.
Oh.
Ad nauseum, I always recommend people to read this book
Okay.
because I feel that, like, I'm an engineer, a science student, and I feel that if you want to learn about investing,
Yeah.
it doesn't help to read only about finance. If you want
Okay.
to learn about investing, you should read,
Yeah.
multidisciplinary. So that book is
Yeah.
very interesting.
Interesting. The biggest mistake investors make?
Being very sure.
Okay.
And like putting all the eggs in the same basket, betting the
Yeah.
house, being dead sure, I think bad things to do.
And the best advice that you've got or you would like to share on investing?
I mean, it's it is, I think, realization after very, very long, which is that, as managers, we should try to keep volatility low.
Yeah.
Because, investing is, अब ये क्या है कि बहुत जगह पे लिखा है कि investing is not meant to be exciting. But maybe I have realized it at the ripe old age of 50 years probably.
I think boring is where the magic happens, so you need to just probably keep
because
doing what
because
you're
that
doing.
is what keeps you in the game. If you look for
Yes.
excitement, you'll get thrown out.
Like you said, don't try to hit a six on every ball, right?
Yeah, absolutely.
Okay, great, Ashish. So on that note, we'll let you go. It's been a pleasure interacting with you. Thank
Thank
you
you.
so much for joining in.
Thank you.
Okay, so that's a great lesson and a masterclass on investing. As Ashish said, the worst is now behind us. Despite the barrage of bad news, the corporate performance in India, as well as the fact that the external headwinds have receded, have worked well for us. If there's one rule of investing for a first-time investor, multi-cap fund is the way to go. Definitely have global exposure, but make sure to have exposure in other emerging markets as well as in India, fixed income and some alternate investment instruments. You can also look to optimize and not maximize when you're investing globally. Small caps and mid caps definitely generate alpha. IT companies, yes, they do have the chance to transform on the AI front. Do remember that consistency is very important while investing. Be in a sector that has a decent or a meaty weightage, and don't lose the wicket and don't try to hit a six on every ball. Do remember that governance, management quality, execution, valuations, and scalability, all of those metrics are important while investing in a company, and expect about low double-digit returns. But do remember, EQ is equally important. Be open-minded and pay attention to what the market is trying to tell you. I hope you enjoyed watching this interview. Do remember to like, share, comment. We'd love to know what you thought about this and who you'd like to see next on the show. And of course, do remember to subscribe to the channel. Thanks so much for tuning in.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.